Welcome back to the Teaching Tax Flow podcast. Today, episode 128. We are looking at those top 5 tax hacks for real estate investors. Before we get into this one, of course, let's take a brief moment and thank our episode sponsor.
Hi, Chris Picciurro here, founder of Teaching Tax Flow, co-host of the Teaching Tax Flow podcast, and pickleball enthusiast. Yes, if you listen to the podcast, you know almost every episode we talk about pickleball, the most popular and growing sport in America. We have tons of opportunities for paddles and pickleballs, but we don't have a lot of great gear on the market. Well, I'm so excited to announce that Sunsets and Dinks are now a sponsor of the Teaching Tax Flow podcast and produce amazing gear, not only to look at, but you feel confident on the court. Because you are part of the Teaching Tax Flow community, you get a 15% discount on all your orders with them. I know I love the gear I received, and I have quite a good record while wearing it. Believe it or not, even at my level. Go to teachingtaxflow.com/pickleball and simply enter TTF15 in the serve up promo code area of your paddle rack.
Hey everybody, welcome back to the podcast. If you read in the title here, we're going to talk about some tax hacks for real estate investors. So why bring that up and why make a point of that? Even if you're not a real estate investor yet, or even if you have no intention of ever doing it, I promise you by the end of this, you're going to learn something. Because even though the content in this is really geared around REIs, that real estate investor, a lot of it is actually going to be somewhat applicable to you at some point in your life. And heck, even if it's not, you can at least bring up some knowledge bombs, drop them at the Thanksgiving table and sound like a genius. So let's stop BSing around it. Let's jump into it. Chris Picciurro, welcome back, sir. Are you ready for this one?
Oh, I'm ready. You know that we spend a lot of time with real estate investors and truly enjoy doing it in our personal lives. And you're right, John. I mean, even if you're not a real estate investor, being aware of this is very important. We have a lot of content on the tax advantages of primary homestead ownership, but we're talking about people that go beyond investing in their primary homestead as real estate. And the other thing to consider is you might not be in a position or that you want to maybe buy a single family home or short-term rental property, but some of these ideas might spur some thoughts about maybe partnering with other people or going into a syndication where you own, like I could say personally, I've invested in syndications where we own mobile home parks and we've owned multifamily and apartment buildings. Like I don't personally want to buy an 80-unit apartment building and be worried about the management of it, but it's nice to understand those tax benefits that come along with it. So yeah, let's jump in on REIs, as you said. You know, we like our acronyms here at Teaching Tax Flow.
Oh yeah. It's, heck, you're basing it off of, CPA, ARA, you have half the alphabet at the end of your name on your LinkedIn page. But this one, I remember specifically that you've done a couple presentations on this specifically. So again, if anybody's listening or watching this and you were at one of those presentations, I know one of them I think was down in Florida not too long ago. It might sound a little familiar to you, obviously, but I can definitely say this, that I remember very vividly doing this presentation, or again, being in the audience for it. And there were so many questions around it because people may have heard of these concepts or these hacks, but they really didn't know kind of the full breadths of it all, right? Like they might know this much. And again, those are watching, I'm kind of holding my finger up just a little bit, but then how they kind of play into each other as well too. So, and which is really tax planning, right? If you don't plan, then, a lot of this you can't take advantage of, or you might miss the boat.
Absolutely. It's proactive planning. Either you pick your tax or the IRS picks your tax. It's up to you. So these are our top 5 tax hacks. There are tons of hacks. And a lot of these things, these strategies can be blended or stacked together. Well, I'm going to just talk about our top 5, paint a picture. Remember, in Teaching Tax Flow, we have a proprietary process for tax planning and strategy, which means diagnose your situation, prescribe different strategies, run through the IQ test. Does it make sense for you financially and non-financially? And then implement. TikTok, Instagram, they are really great resources for ideas, but ideas are cheap. Implementation is valuable. That's where the Teaching Tax Flow community comes in, helping you with these implementations. But let's just talk about our top 5 tax hacks. I'll give you a 30,000-foot view on each one, and we're going to jump in with both feet.
Sounds good. Let's do it, man. I got my swimsuit on.
Oh, good. Well, John, I appreciate that you wore your normal shorts and not your banana hammock this time as a swimsuit. I know you've donned that at many times when we're on the road and we go to the pool. You like to strut your stuff around. So
Oh, well, how do you know that? These webcams, they're very good at, cutting off half of the body. I could have one that says TTF on it in places that we do not mention. So
well,
talk about hacks.
we'll take that branding. And anyway,
There you go.
so like number, and again, these are in no particular order. These are just the ones we're seeing most popular. First one's going to be the 1031 exchange. So remember, one of the 3 laws of teaching tax flow. Tax agencies are your involuntary business partner. Tax laws are in to encourage and discourage certain behavior. So if you're in a situation where you want to sell a piece of real estate, maybe you're repositioning and you don't need the cash in your pocket, you want to have another piece of productive asset. A lot of times we find people that are landlords or rental property owners, and they want to be more passive. They want to shift their portfolio somewhere else. The 1031 exchange works really well. They can sell their property. They can defer all of their capital gain, redeploy that into different assets, and still get mailbox money and not give, anywhere from 10 to 40% to the government. So the 1031 exchange is really, really popular. You don't have to be a full-time real estate investor. Anyone could do the 1031 exchange. There are obviously, and I've done a 1031 exchange myself. There are obviously rules and regulations. You can't have the money hit your bank account. You have to use something called a qualified intermediary. There are rules as far as identifying a replacement property and being able to close on that replacement property. John, we just, in the last few months, did a podcast on Delaware statutory trust, which is a type of 1031 exchange. Ultimately, if you're in a situation where you are selling a property and you're going to have a large capital gain and you don't necessarily need that cash and you don't want to give a bunch to the government, let us know. We could get you in contact with a qualified intermediary, and then you could start looking at what's called replacement property. Now, one thing to consider on 1031 exchange, this is a commonly asked question. If I were to sell a residential property, right? If I was to sell a residential property, do I have to buy another residential property? No, you don't. It just has to be like kind. It has to be investment property. So we have several people that sell a residential property and buy into maybe, like I said, a syndication where they want apartment complexes or commercial property, or it could be any type of real estate that's investment. That's an investment. So that gives you a lot of flexibility. You can sell one property. I've had clients that have sold one property and bought several other properties because they just wanted be more diversified, in especially not only in asset class but in geographic location.
Yeah, and anybody that's interested in this, Chris, you mentioned a great point. You have to go through a QI, so it's that qualified intermediary. If it hits your bank account, sorry, too late. You're out of luck, kind of deal. And if anybody's interested in the podcast that we've mentioned this on, which has been many, in some way, shape, or form, and also content on our website, YouTube, etc., wherever you see something teaching tax flow, just do a search and type in 1031. That's literally like the number 1031, and you'll get a handful of stuff. It searches everything we have, and it's great. So you can dork out on it. But I'll say the one piece of advice I feel like I said on the last time we talked about it is, literally, you have to plan for it. I feel like I'm harping that like crazy now, but you don't want to have to make that call at the witching hour saying, oh crap, I'm sitting at the closing table, sipping on my sparkling water, about to be a happy camper, but oh boy, I forgot something. So not that I know anybody that's done that or anything, but
exactly. You've got to take care of it before closing. And John, you know what? I'm going to challenge you on something. I'm going to challenge you to come up with a cool drop for this podcast every time we use a tax-related acronym. And you said QI. So we got to come up with some type of jingle. We got to have something. I think that would be fun.
Yeah.
And I'm impressed, John. You dropped a QI on us. I feel like you really learned a lot through the podcast.
I think so. Well, what's that line that you always say? You don't know it until you teach it. Well, I feel like I've taught it to myself on this from osmosis from working with you on these. But yeah, it's a great hack. It's a great strategy, and there's so much power to that one specifically. And we'll have fun with some noises. If anything, if anybody's, really wants to geek out, you just have to listen to our podcast and make a drinking game out of it every time we drop an acronym. And I mean, you'll be in good shape by the end of every
Right.
episode.
Yeah, don't listen in the car then, right? Make sure you're taking your dog for a walk or to going for a jog.
Now
Let's have it
somebody's
going
going to get
for
a public intoxication citation.
oh, man. Well, another one is gonna be now, but before I say this, John, this is a hot button issue for me, and this is this is a strategy that is often used too early, prematurely in the life cycle of a business. But for the right situation, it could save a significant amount of payroll taxes. That's S corp election. So if you're in the real estate business, let's say you're a broker and you can have your commissions paid to an entity, or you are a full-time house flipper or a wholesaler, and you have a profit of $150,000 or more and you're self-employed, the S corporation election can make a really, really big difference in your tax bill. It is not a good option if you have buy and hold real estate. So S corp election is number 2, often overused. But real story, John, we just in our private CPA practice, where we worked on a case where we had a taxpayer who has a significant amount of income, well over $200,000 of self-employment income in the real estate business. His spouse helps him out with the business. And they have well over $20,000 a year medical expenses that they are getting no deduction for. In that case, we did an S corp election for the business. We're paying the operator, and we're going to pay his spouse a fair wage based on what we call a reasonable compensation study. Yes, we have an episode just on S corps that John made me do. And
Episode 120, by the way, if
thank
anybody's
you.
interested.
And also, we implemented what's called a Section 105 plan so that the business can reimburse employees for out-of-pocket medical expenses. And now this whole thing is going to save them, we think, between $18,000 and $20,000 a year. So in that case, huge savings.
Absolutely. And Chris, I would say, or you tell me, am I wrong in saying that the S corp election is definitely one of those strategies that's kind of out there, probably the most on social media reels? And I feel like they're almost like hype videos. Like they get people very excited about it. But, as we discussed in that podcast 120, it could be a sticky situation if not
It
really.
could be. Here's
Again,
the way
play
I'm
it
looking
for 'em.
at this, John. You ever been to one of those? I haven't been in a while, but in my younger days, we used to go to all-you-can-eat pizza buffets. Very dangerous place to go if you're trying to.
Wasn't it like a Pizza Hut that used to do those way back in the day?
They had lunch ones, but there was other ones. Most of them have been out of business, actually. But these all-you-can-eat pizza, I think, is it CC's Pizza? Whatever. You're not a sponsor, so I'm not going to mention your darn pizza. But here's the thing, John. You and I going to the all-you-can-eat pizza buffet for $10. You and I are going to pound down about $30 worth of pizza, right?
Oh, yeah.
Right. You take your daughter, who might is about 4 years old. Is she gonna eat $10 worth of pizza? Probably. Probably
No,
not.
probably $2.50 and $1.25 that's going to be on the floor.
Or let's say you bring in someone that just wants some salad and one little slice. My point is, the S corp is like the buffet. If you're gonna eat a lot, it's worth it. If you have a lot of profit, it's worth it. If you don't have a lot of profit, it's not worth it.
Great analogy. It's the pizza strategy.
The S corp, all you can eat pizza buffet. I'm gonna use that in the future.
Yeah.
Number
We'll find a
3.
way to make like the S stand for saucy or something.
Yeah,
We'll come up with that.
I like it. Number 3 is going to be, and we have an entire episode on this, cost segregation study. So what this is doing is it is allowing you to front load the deductions for your real estate that you buy and hold. Okay. I'm not going to worry about too much about the mechanics of it here, but if you have buy and hold real estate, you might want to consider a cost segregation study, because you're able to take out the personal property portion. Now that's a mouthful of the real estate, and take immediate deductions for it. When does this make sense? You've got 3 situations. 1, if you are a real estate professional status with the IRS and you want to offset your active income. 2, if you own and operate a short-term rental property and you meet the short-term rental loophole. Oh, but what's that? Well, guess what? You better go back to that episode and listen to it, because it's pretty darn good.
And that's another one that we've talked about a couple times too. And yeah, there's some real meat to that one. Huge, huge benefits.
Oh, you're staying on the meat lovers pizza? Uh,
Yes.
Number 3, if you are trying, let's say you are a passive investor, but you want to generate passive losses, you could do the cost seg study. Why? Well, not every tax advantaged or tax strategy means that we need deductions today. Creating passive losses could create tax-free cash flow in the future. Or let's say you sold one of your passive rentals and you have a big gain, you want to pair that with a passive loss, and you could hit that cost segregation study on it. So cost segregation study number 3, it's pretty much the best bang for your dollar when it comes to tax strategies in real estate. Now, I'm going to mention this. Maybe I did mention it. I don't know. I've been on a roll today. Tax strategies, John, they don't like being lonely. They're not Han Solos. They want a friend. So when you're
It's
talking
like
about tax,
mustard and ketchup or peanut butter jelly,
peanut butter and
even though a
jelly,
lot of
right?
people
No,
like one or the other.
yeah. So tax strategies should be blended or stacked together. They don't live on an island. So when I talk about the next one, it's typically blended with the second one I mentioned, which is your S corp election, income shifting. So income shifting to family members, such as a spouse or children, can significantly reduce your overall tax burden. It could also allow you to provide employee benefits and group benefits to your family. And especially if you're income shifting to children, it could be paired with, hey, let's pay our kids, we have content on this, right? It's got to be a fair wage for the work that they're doing for the business, okay? But let's say you could pay your children $15,000 a year. But they're not going to pay much tax on that at all, but then they can contribute to a Roth IRA. So you're pairing maybe a Roth IRA contribution with income shifting. So if you're operating a real estate business, shifting income to your spouse or shifting income to your children can make a lot of sense. If you don't have a spouse and you don't have children and you still have a significant amount of net revenue, income shifting to a related entity like the 831B strategy, which we have an entire podcast on that, could make sense. And if you don't have a spouse and children, you probably have a lot more profit than, well, you're probably going to
Touche.
say, but you have a lot more disposable cash.
Yeah. And I think it was episode 113, again, kind of a shameless plug. I think that was the one, 13 or 14, that we called it, or titled it, I should say, Should I Pay My Spouse? Where we dive into that specifically.
Right.
And that was another good one.
So income shifting, both to related entities, and if you don't have a related entity, does it make sense for you to create one, or to family members? So that's my 4th one. The final one is one that I love to pair with cost segregation studies, Roth conversions. Okay, John, I'm going to paint a picture for you.
Bob
What's your
Ross style,
favorite
happy
food,
trees.
John? I don't think it's pizza, but I can't remember.
Oh. Let's see. Believe it or not, tuna fish salads. Oh, that's kind of weird. No, we won't make me sound like some crunchy person here. We're let's say steak.
Okay, here's what we're going to do, John. You and I are going to go out to dinner. We're going to go to a beautiful steak place. You're going to have a nice steak. And when you go to pay for the steak, they're going to say, no, John, you don't have to pay for the steak. Well, okay, you consumed it, you enjoyed it. Yep. Actually, John, in 30 years, you're going to pay for that steak, but you're going to pay whatever that steak's price is in 30 years from now, which we have no clue.
That's like filling up your tank with gasoline 30 years ago. Well, let's say 25 years ago, right?
Well, that's what
Would've
people
been
do.
better to do it at the pump then than now.
Well, and that's where the argument for maybe putting money away into a Roth or doing a Roth conversion today, paying the tax on your Roth conversion today instead of whatever that's going to be in the future plus its growth. And we do that all the time, right? So Roth conversions are great to pair with cost segregation studies. So if you are in a situation where, I've had real situations where we have people making $400,000 of income, they buy an apartment building, et cetera. They get a cost segregation study to come in at a $500,000 loss this year. We've got a bad situation now. Now we got $500,000 worth of loss and $400,000 worth of income. We're using deductions at to wipe out 12% marginal tax rate. And we have $100,000 in deductions that we have to carry forward to the next year, and we only get to carry forward 80% of them. The point is, the cost segregation study created a loss that's now inefficient. What do? The first thing I'm going to do is talk to that taxpayer and say, do you have money sitting in your 401k, old IRA? Yeah. Well, guess what? Why don't you convert that to a Roth this year, ultimately pay almost no tax on that, and now that money's going to grow tax-free the rest of the year. That's another example of blending the strategies. So Roth conversions, you might not think about real estate investors when it comes to Roth conversions right away, but a lot of times Roth conversions make sense, especially for people leaving corporate America. Maybe they had those higher W-2 wages, they get into real estate, maybe they that first year they're not making as much money. You want to do the Roth conversions when you have a lower marginal tax rate.
Right. And everything we talked about here, Christy, I think it's super important, for somebody who is not in this world yet, or maybe is thinking about it. It is a business. It's not just like selling things on eBay here and there. Like, you are forming an entity most likely. And then a lot of these strategies, right, you have to be aware of them again, because it's almost like if you take one leg off of a three-legged table, right? It's still a table. It's just, head over heels. It didn't go the way you wanted to, or, you went to the pizza buffet and all the pizza was gone. Either way, there's a lot of bad examples, but I say that with it being a business because treating it as such really does kind of set the precedence for success, right? And knowing what you have going on. And I think kind of a twofold, right? It helps you kind of plan for ways to obviously implement tax advantage strategies, but then also it helps you just frankly grow and manage your business because you treat it like that, right?
Absolutely. Remember, you want to pick your tax. If you don't pick your tax, the IRS will for you. So those are my top 5. There are several other ones. We pretty much have a podcast episode on all this. We have YouTube information. But yeah, if any of this, piques your interest, or if you just want to be a friend, bring a friend into the Teaching Tax Flow community. Just check out teachingtaxflow.com or jump into the Defeating Taxes private Facebook group. And John, selfishly, we get a bunch of our content ideas from our community. So thank you.
Absolutely. In some way, shape, or form, right? It's either conversations, questions asked. Sometimes it's answers to other questions that were asked. It's really interesting seeing how they come up. So as always, this is a great topic that we dove into. If it wasn't great, we'd kick it to the curb and delete it from our spreadsheet, our little roster that we keep. But we do have some great guests coming up, and obviously some great topics still on the radar here. And then, here we are kind of that time of year. We're not going to say that thing that we call tax day because it really doesn't exist in our world, but keep planning, keep yourself educated on all the strategies that are out there and all of the really just industry tax fed news that's coming down. Be the smartest guy in the room. Anything we can do to assist you by doing that, feel free to reach out. We are here. Anywhere you can search Teaching Tax Flow, you will find us everywhere. Shoot us a message, shoot us those comments, and we'll see you back here again next week on the Teaching Tax Flow podcast. And I almost forgot. Different time, roughly, different date, completely different topic. Have a good week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.